We're going to work on Morton's company's contribution margin format income statement, and also they've got some changes to the scenario, and they want you to respond to those changes and also calculate a couple of ratios. So let's have a go at this. So I've repeated the data that they gave you, 49,000 units. They tell you the sales price, and we can calculate here what the variable cost per unit is by taking the total and divide it by the units. And then contribution margin is sales minus variable cost. So we can kind of fill in the rest because we know how this works. And of course, we can also calculate the contribution margin ratio percent, which is contribution margin over sales. All right. So this is the current scenario, and they want you to respond to a change. If they get some new equipment, this $18.90 is going to go down by $8.10. So this minus $8.10. And fixed costs are going to go up to a new number, $714,420. All right, so they're reducing their variable cost, increasing their fixed cost, okay? And there are no other changes, so the sales price is the same. The number of units is the same. So now we can calculate the new contribution margin, and we can calculate the new sales, units times the sales price. We have a new variable cost because it went down by that $8.10, and our contribution margin is still sales minus variable cost. And so we have new net operating profit of contribution margin minus the new fixed cost. And the net operating profit is exactly the same. Well, isn't that a coincidence, huh? Okay, and we can calculate the new percent of sales. So that variable cost percent is the variable cost over sales. And the contribution margin is the contribution margin over sales. And these two complement each other. They always add up to 100%. See that? So if you know one, you can immediately get the other. All right, so that's before and after. So we would be indifferent on this decision. We'd be equally happy either way. That's called the point of indifference. All right, now they'd like you to calculate some ratios based on the original assumptions, the original contribution margin statement given. So they'd like you to compute the degree of operating leverage, and that ratio is the contribution margin divided by net operating income. So we can do that math, and it's expressed as a decimal typically, so that would be 5. And then they want you to do it again, I think, for both scenarios, right? So we'll also do it over here. So we'll take the contribution margin over the net operating income, and we get a much higher degree of operating income because even though the total expenses are the same, total profit is the same, the proportion of total costs that are fixed has completely changed. So here you have the same expenses, but they're just split differently, 900,300 versus 500 and 700. So it's about 1,200 rounded. In both places, it's just here you're heavy in fixed cost and here you're heavy in variable cost. So they have a different proportion of fixed versus variable, which is what the operating leverage ratio tells us. All right, break even in sales. So break even always has fixed cost in the numerator. And for sales, we need that contribution margin percent. And so we get $1,058,000. But over here, we have a much higher fixed cost. So we may have to sell more, except our contribution margin is higher. So we have both of those things going on. So let's see here. So we have to sell more to reach break even when fixed costs are higher. All right. Margin of safety is the difference between current level or budgeted level or expected level and break even. So right now we're at the sales of the $1,323,000. We just computed break even, and so the difference between those two is the margin of safety. And margin of safety percent takes the margin of safety in dollars and divide it by current. So it'd be 20%. And then for the new scenario, the current sales is the same, but the break even in dollars is different. So our margin of safety is going to be a little bit smaller. And that percent, the margin of safety in dollars, divided by the current level of sales. So that margin of safety is smaller. All right, and then in scenario 4, we're going to make some changes here based on this scenario. So rather than purchase equipment, they're going to hire. So here in requirement 4, we're going to eliminate sales commission. So we're going to take away a variable cost, and we're going to replace it by a fixed cost. All right, so our new fixed cost is this $506,709, but it doesn't tell us how much the variable expenses are going to go down. Instead, it tells us enough for us to figure out how much that variable cost will change. It tells us that the net operating income is going to go up by 20%. All right, so let's go back to the original, times 1.2 for 20%. So now the new contribution margin would be those two added together, because something minus 506 gave you 95. So we would add the two together, going back up the income statement. And then sales per unit, the sales price didn't change, but the number of units is going to increase by 30%. That's kind of impressive. So times 1.3. And this part so far is following instructions. What changed and how much did it change by? And once we have this, now we can solve for the rest. So sales is units times sales price. And now we can solve for variable cost, because the 1,000,007 minus X gave you 601. And so it is the difference between those two numbers. And so we can calculate the contribution margin percent and the variable cost percent. So the variable cost percent is the variable cost over sales. Oops, let's move it down here so we're calculating that correctly. All right, so contribution margin percent is the contribution margin over sales. Wonderful. So now it wants to break even in sales. Okay, so we have this new fixed cost, and then we have this new contribution margin percent. And so we will have a new break even in sales. Let me know if you have questions.